What's up world? Hap here, and welcome to the first in a video series I'm calling How I Trade. This will be a video series of my personal daily vlogs where I ask myself the question, if I were to take just one trade either for the day or one trade in the AM session or New York PM session, what would that trade be? I've been working on taking less trades of higher quality rather than over trading and taking too many small unnecessary trades, because when back testing and looking back in the charts, you can really see where the optimal trade entry would be. So I'm not going to be teaching or declaring what I believe is the right way to trade in this series, but it's going to be showing and sharing how I trade, and hope that people find some insight or inspiration from the way that I'm looking and seeing things. I'll be using terms from ICT Concepts, the Inner Circle Trader. So if you're unfamiliar with his trading, I highly recommend going to his YouTube, as I will not be fully explaining his concepts and using certain words or terms. But today what we're going to do is look at the E-mini S&P 500 and the NASDAQ future contracts for last Monday, in particular because I saw that there was two forms of my model that I use appeared in slightly different ways on ES versus NASDAQ, and thought it would be interesting to look at the differences and similarities to train our eyes in how to see the various ways in which price might present the models. So pressing Alt-G, jumping to the AM session here. So the first thing that I'm going to do to start is look at what was the move, which is very clear here, and what did price do leading up to this move, and how could I have gotten into it using the concepts from ICT and the models that I have formed from that. So what I've used here on this one is what I call the OOF model. That involves an order block, OTE, optimal trade entry, and a fair value gap. But there's more to it too. So to start, what I do every day is I mark out midnight, New York midnight, and then I mark out midnight open price. Because part of how this model that I use works plays into the power of three: accumulation, manipulation, and distribution. And we're taught that if you're going to be a buyer, it's best to do below or near midnight open price. And if you're going to be a seller, you want to be above or near midnight open price, ideally. And we can see right away from midnight open price that price did go beneath it, respect it, and move away. You can actually see on a higher time frame the way in which it kind of also came into play in the PM session. But for this AM session here, the other thing that I'll be looking at, so first our midnight open price, and then now what are the draws on liquidity. Now we have back here, we have I always like to mark out previous day's highs and lows. So in this case here, our previous day high was there. And since we are looking in hindsight, we could see that this low did not come into play until Tuesday, so I'm going to leave that off for now. So we have PDH here. We have our overnight accumulation, which is ideal for this model that I use. And then I'm going to mark out the London highs and lows, or just overnight highs and lows. Let's see, we have some relative equal highs here. Failure swing there. And then we have relative equal lows here. So the steps for this model is that I want to see some amount of accumulation preparing for a big move. I want to see manipulation in the form of a stop rate, which we can see here because we have sell stops residing beneath these lows. We see them rated here with this wick, and then the body's closing at the low. And then we have a displacement away from the low above these short-term highs, leaving behind a fair value gap, creating more relative equal highs, generating buy-side liquidity, and then retracing down. So we have our fair value gap here, because it's so in the OOF model, we have OTE, OB, and F is the fair value gap. Our order block, these down closed candles here that take liquidity before price moves away and changes its state of delivery to go to buy side. So here we're working our way lower. We took sell side. Price has now changed its state of delivery from seeking sell side to seeking buy side. So this is our order block here. I like to use the open of the order block. So we have that there. And then optimal trade entry is where we're looking for price to reach down if we're looking for buy side, looking for longs, for price to reach into a discount before seeking buy side. So in this case here, again, I use the bodies because as ICT teaches us, wicks do the damage and bodies tell the story. So from the body low to the body high of this expansion, we have our OTE fib level here lining up with our order block, which is always a good sign. And in general, we just really want to be below 50% for optimal trade entry, but the 618 level is great, especially when it lines up with our fair value gap with our order block. And then how the expansion didn't actually take the highs, but just created more buy side liquidity, showing fake resistance to the longs. And then our entry would be here. Stop below this low. Only need a 3-handle stop. Targeting at least PDH. But for a higher target, we can see here the standard deviation extension of 4 worked out really well. The other thing that I noticed too was that if I were to take from this last swing low, wrong way, swing low to high, the -4 extension is 5,066.50. Look at the high of this candle up here, 5,066.50. Perfect. So that's neat. But in any case, it's as simple as that as far as what I'm looking for in my OOF model. So to recap, for the OOF model, looking for accumulation, ideally this overnight accumulation leading into the New York Open, which is right here, 9:30. Then having some sort of stop rate, which we have here, which would technically be a turtle soup entry that I don't really take. It came below midnight open and then immediately rejected it with displacement, created these relative equal highs here without taking the highs, left our fair value gap behind, which we then retraced back into a short-term discount into our fair value gap, closing above that OTE level, respecting this order block, and then off to the races. So that's going to be it for the ES portion. Now I wanted to look at the same thing for the NASDAQ because I found that to be valuable and interesting as well, how it did a similar setup but with some subtle differences. So this is the NQ, and also of note on ES we were on the 5-minute chart. I'll start from the 1 hour, see what I can see, drop down to the 15, because the higher the time frame for the entry, ideally the better, but And while there is, I could see it kind of here in the 15, we don't have our fair value gap, which is part of the model in which I use. So from the 15, I'll drop down to the 5, and that's where I was able to see. So if I could see it on the 5, I'm not dropping down to the 1 minute time frame. However, on NQ, on the 5 minute time frame, it was still a little too smushed together, and I couldn't quite see what I would be looking for my model. And this, so I dropped down here to the 1 is where I was able to find it. And this is where I could see what I've been recently kind of calling the slope model, because I have just been fairly recently noticing this occurring in the charts repeatedly, which is where, so similarly, we have our overnight accumulation. Price is kind of staying in an overall tight range, no real big moves like what we would want to be getting into later here, kind of just generally bouncing around. So similarly here, I would be looking at where midnight is, and then adding our midnight open price. And again, just to show you how powerful midnight open is. So midnight open price is here all the way on Friday. Look at how clean that rejection is there off of the midnight open price. Body's closing below it. But not to get off and sidetracked, just wanted to show that. So we have midnight open there. We have our low of London low and overnight low right here. Sell side. We have our overnight, our London high right here. Here, I'll just use my London high actually. London high there. And then we have our buy side liquidity, or PDH, previous daily high, or the drawn liquidity right there. I like to use daily highs and lows when possible as my draws on liquidity. So here's our basic framework. We have our midnight open, we have our overnight low, overnight high, and PDH. So coming into New York Open, right here, we immediately on New York Open have our stop rate similar to how we did on ES right here. So that ran out this low here and the liquidity over there, and then immediately displaced higher, same as it did in ES. Took this high but didn't take our overnight London high here, so we still have this low resistance liquidity up there. But what makes this different here, and what I call about the slope model, is this right here. So we have this series of failure swing highs that don't take each other out, and thus we could potentially have stops here, 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 and low resistance liquidity runs to the upside because of the nature of there being an easy grab for liquidity here, here, and here. That hasn't happened yet. And so what I'll see this happen a lot is this kind of sloping down here with a relatively flat bottom, because you see here we have our respect of the midnight open price. And then before price changes its state from working its way towards sell side to working its way towards buy side, we have our last little raid right here that takes this out. And so similarities and differences here, we have our accumulation, we have our manipulation and distribution. And what I like about the slope model is, by the nature of having the clear decline there with the relatively flat bottom here, it's easy for me to directionally see that we're going to want to run all these out towards buy side. We've taken out all the sell side from here is already gone. There's still all of this buy side from here to here to here, and PDH there. So that would be our draw and move. Other confluences that would help me get into this trade and relate to the OOF model. We have an order block here because this is our high probability order block because this is what took our liquidity there. If I were to draw from here to here, we can see how the 50% of this final candle here, or the 75 of this whole piece, gets respected there. We have our fair value gap here. Price doesn't even reach into the bottom one, but what it does reach into, and what also gets used here that's different, is we have our opening range, or rather just New York open fair value gap, the first fair value gap that gets created after 9:30, which if you backtest and look at, you'll see plays a role in a lot of the way that price reacts off of things. At least in my studies, I've seen that. So this is the 9:30 candle right here. This fair value gap gets created, and we can see how price is kind of respecting or working off of that. We have this fair value gap here. Price only comes down to there, wicks down, closes bullishly. If I were to draw from here to here, this is the final this is the manipulation leg. This is the final move down before we actually change state and move longer, which we can use for standard deviation projections. And we see that the negative 2.5 comes out pretty cleanly right here, where price is rejecting and tags in. And then if we look at the displacement here over this high on our first movement, showing our market structure shift here that creates the fair value gap, this is the candle that I would want to be entering on. And we see again, we have it at our 618 OTE level in a short-term discount of the displacement leg that takes the first swing high in our market structure shift. And then would be targeting at least London high. Could have a safe stop down there, and that's already a over 2 to 1. Targeting PDH gets you a 3 to 1. That 2.5 standard deviation, excuse me, would be even more. But to be reasonable, a 3 to 1 trade right there is great, to be honest. So to recap, similarities but differences here. We still have our overnight accumulation, consolidation. We mapped out our session highs and lows, our midnight open price. We saw that we had a accumulation and then a manipulation in the form of a stop rate here and here, and then our distribution there. We have, in terms of confluences and support in our favor, we have all this buy side. We have our New York open inversion fair value gap. And what makes this an inversion fair value gap is, a normal fair value gap would be like this one here, where price tags into it and then moves lower, versus this one here where price moved through it and then used it as support later. We have our market structure shift. We have our high probability order block, OTE, fair value gap, and that would be the AM session that I would trade. And hopefully you can see the similarities and differences. We're still using order block, OTE, fair value gap, accumulation, manipulation, distribution, draw on liquidity of relative equal highs and failure swings and previous daily highs as our targets on both, but price manifested itself slightly differently. Hopefully people found this insightful, and good luck and good trading, everyone.